This is a graph based on the Case-Shiller Index of home prices in the United States for the past 10 years. This one is for the past 5 years, and this one zooms into the past 12 months. The index fell slightly for the first time in 45 months since January 2019. What a different world it was back then. And not just in Ukraine, but also here in the US and globally. What's causing this decline in home prices? The causes are complex, in part because price changes in the different segments of the housing market, geographic location, price points, home types, are not uniform. In fact, in some segments, home prices are still going up. But in general, this recent concavity in home prices, based on the broad average of home prices across the US, is driven by several key factors. First, and probably most important, the higher interest rate. In response to the fears of a rising and potentially long-term inflation, the Fed raised the interest rate 5 times. Here, 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 and here. As a result of this contractionary monetary policy, mortgage interest rates took a hike uphill. The 30-year fixed rose from an historic low of 2.65% on January 7th, 2021 to 6.7% on October 6, 2022. The higher mortgage rates are making home buying a lot more expensive for most folks. Some people can't even qualify for a loan anymore. And those who do can afford a far smaller home than they hoped for when the rates were lower. So, for example, at the 2.65% interest rate, a family looking to keep their monthly PITIA at $2,700, and we have to make a couple of additional assumptions here, could afford to buy a house for $500,000. But now, at the 6.7% interest rate, with these same assumptions and the same PITIA, the same family can only afford a house for $350,000. Sorry, little Susie, you can't have your own bedroom yet. While this absolutely is a massive change, historically the 6.7% interest rate is not crazy high. Actually, historically, 2.65% is crazy low. The weekly average, based on Freddie Mac data on all weekly 30-year fixed rates going back to 1971, is 7.76%. But then again, a 150% hike in the interest rates so fast is not at all pleasant. Before we go on to the second reason for the drop in home prices, let's digress for a second and talk about the inflation and the Fed's response. First, given the latest move by OPEC to restrict the production of oil, which will add more fuel, pun intended, to the inflation, the Fed may have to tighten the money supply even more. The Fed's aggressive stance on the inflation is, on the one hand, understandable. It wants to send the message to the public that it will do whatever it takes to rein in the inflation and thwart the self-fulfilling inflationary spiral. On the other hand, this policy will cause pain. And the question is, does it have to be this much pain? This is a lot of tightening. And the inflation is likely the result of global disruptions, including in commodities due to the war in Ukraine, rather than due to the overheated labor market. Prices in many sectors, including housing, came down or slowed down. So brace for a painful couple of years. Read up on the sacrifice ratio and rational expectations if you want to delve deeper into macroeconomics. So the second reason for the falling home prices is that the pandemic that fed the stratospheric rise in home prices due to the internal migration and demographic shifts, work at home, saved cash, and colossal stimuli is over. Well, kind of. As a result, the massive surge in the demand for homes is also over. And third, the economic uncertainty in wealth and income and employment is just bound to cause a gloom of pessimistic expectations. And that is, can be a powerful killjoy of the home shopping mood. If you're wondering how deep the housing market correction is going to be, subscribe to this channel to get our updates and new analyses. These were all economy-wide trends, but let's do some local numbers for a more refined, granular analysis. I'm going to look at 5 indicators of the health of the housing market based on Palm Beach County, Florida. The median price of single-family residences in the Palm Beaches is down from a peak of $675,000 in June of this year to $623,000 by the end of September. That's a drop of 8.3%. Townhome prices fell from a high of $410,000 in May to $380,000, also almost 8%. Condos plummeted 14.5% from the high of $380,000 in April to $331,000 last week. I just have to say, wow. I mean, to be sure, I was expecting some decline, but this is a deeper slide than I thought I'd see. Keep in mind, though, that these changes are not on a month-to-month basis, which would be much less dramatic. Hey, by the way, this chart with live market numbers, updated monthly, is available on our website, www.Munara.info. Days on the market is a great indicator of the market's hotness. In the froth of the feverish housing market of a few months ago, many homes were getting under contract within hours. The median days on the market bottomed out in February-March of 2022 at just 5 days. That's 1/8 of the long-term average of 40 days that it took for a typical home to sell. Those sweet days for home sellers and their agents are over. By the end of September, the effort to sell a house, at least by this measure, almost quadrupled to 19 days. Yeah. This chart too shows that for home sellers, the awesomeness of having flocks of home buyers fight it out with tens and even hundreds of thousands of dollars above list price is over. The share of listings closing above the asking price has dropped from 54% in the spring of this year down to the top of the normal range today. This picture, showing the percent of homes bought for cash, isn't as dramatic as the previous ones. But still, there is a bit of a drop in the amount of cash used in buying real estate property. And finally, how many home sellers had to take off their rose-colored glasses and lower their list price and kick themselves for missing the train of selling opportunity and of a family vacation in Europe? Just look at this. You gotta love the numbers, as they never lie. Just 6 months ago, 95% of sellers didn't even bother reducing their already bloated and maybe a little hubristic list price. But now 39%, that's 8 times the difference of listings, had agents do the tough job of convincing their clients to revise the price down. So, there you have it. Both broad national indices and a close examination of local data show that the housing market is now experiencing a downturn. How deep and how long will this last? We'll be posting regular monthly updates, so if you want to stay in the know, bookmark this channel and check back often. Until then, arrivederci.